Today's roundtable is sponsored by our good friends at Unit21. Unit21 helps risk and compliance teams in the crypto and FI space navigate the rapidly evolving regulatory space and combat operational threats. So you'll hear more about Unit21 towards the end of our session today, so make sure to stick around for that. Finally, before we get rolling, a quick disclaimer that the views of the moderator, myself, and our panelists are not associated with the organizations that we represent, nor should anything on today's roundtable be construed or taken as investment, legal, compliance, or any kind of advice. So with that out of the way, I'd love to get rolling, and I'd like to invite our panelists to come on screen, and we'll kick it around for some introductions. So thanks all. So let's go Christina, Nisha, and then Stephen. Tell the audience who you are, the firm you represent, the work you're involved in, and just everything we should know about you as we kick off today's discussion.
Awesome. I will kick off. Thanks, Bennett. Thanks so much to Blockworks and Unit21 for inviting me. I'm really excited for this session. My name is Christina Ray Baxter. I'm the founder and CEO of Raycor Consulting. I run a boutique consulting company targeting fintechs of all kinds, but specifically crypto firms that need assistance with compliance advisory. I do a lot of fractional CCO work, a lot of typical advisory work, and I am also an expert witness in plaintiff side litigation, and I've done that in a number of crypto cases. So it's kind of interesting to see this from two different angles.
Hi, everyone. My name is Nisha Felix, and I am VP of International Compliance at CoinList. And at CoinList, we help top crypto projects launch, grow, and connect with users, from token sales to trading, staking. And my focus is really to ensure that we scale globally while staying on the right side of the regulatory framework. And as we all know, it's a fast-moving environment. So basically, I live at the intersection of innovation and compliance. Many thanks to Blockworks and Unit21 for having me today.
Yes, thanks, Blockworks, Unit21. My name is Steven Sargent. I run and operate Airdropped. We're one of the only crypto compliance-specific media agencies working with top companies to create fun, engaging thought leadership. But my background is actually in crypto compliance and blockchain investigations. I've worked at both traditional banking institutions and some of the largest crypto exchanges in the world. And I'm excited to talk about regulation, compliance, and everything in between.
Thanks, everyone. Yeah, so a brief overview for kind of what we're going to cover today is kind of a regulatory state of the union, both in the US and globally, and then a lot of those downstream effects and implications for compliance professionals and folks in both the crypto native space as well as the kind of more traditional financial institutional space. But first, let's cover kind of what is the existing landscape of global regulation. So first question, maybe you can kick it to Nisha and Christina first. How would you kind of paint the picture of how global regulators have made initial attempts to ensure trust or set up safeguards in this sort of crypto native token-based economy?
Yeah, I think that's a really great question. From my point of view, I think the honest answer is they're mostly retrofitting old systems onto new tech. Basically paving existing highways onto crypto rather than building new roads. They're taking decades-old frameworks like securities laws, banking rules, privacy mandates, to technology that works completely different. And it leads to some pretty awkward fits. Some jurisdictions are further along than others in terms of the regulatory landscape. EU definitely with MICA or Mika, however you say it, is trying to lead the charge, especially over us in the US. We're kind of coming out of the Wild West of crypto, maybe into the industrial revolution of crypto a little bit more. But regardless of where you are, I think the initial rules were built for, account-based centralized systems with clear intermediaries. And crypto is wallet-based, decentralized, and borderless. So it's creating some confusion and friction, especially in areas where there's already a lot of confusion and friction, like DeFi and multi-chain ecosystems. So, even though it looks like there's progress, I think there's still a lot of work to be done.
Yeah, and I definitely agree with Christina. I'd say that global regulators, they've started by laying some foundational guardrails to build trust in token-based economies. And it may seem that they're not moving at the same pace, and they're really not. Because first we've got the FATF, and they're pushing for a consistent global standards around AML, especially with things like travel rule. Then we have regions like with the EU with the implementation of MiCA, where and other jurisdictions are implementing licensing requirement. Many jurisdictions now require CASP and VAFs to register to obtain licenses. And if you're operating there before, there's a grandfathering provision. So you're allowed to continue operating there, provided that you do complete your registration within a certain period. And those are really just the minimum standards, operational standards for AML and compliance operation, as well as user protection. But the AML CFT standards is applied to those crypto businesses are mostly guided by FATF travel rules. So although we're seeing some cross-border joint efforts with bodies like FATF and FSB, where they're sort of trying to promote like a unified strategy in an attempt to, I would say, prevent regulatory loopholes and strengthen oversight, it's still not perfect. So overall, the early moves have focused on sort of clarifying who's responsible, requiring sort of like a risk-based controls, and bringing crypto, I would say, more in line with existing financial standards, but it's really not perfect yet. It's going to take some work, but we are seeing some real progress towards creating what I would say is a safer and more trustworthy environment.
Yeah, appreciate both those answers. Nisha, could I ask a follow-up on, you mentioned kind of the VASPs and the CASPs and the FATF. Could you kind of, for those who are less familiar with those things, could you give kind of like a high-level intro to what those are and kind of how they fit into the existing kind of regulatory framework?
Sorry, FATF is the Financial Action Task Force, and they put like global standards for regulations as it relates to AML and compliance, but not every jurisdiction is following those, right? And I think to get crypto in line with those standards, virtual asset services providers would need to get the legislation would have to cover those. The legislation was really made for TradFi, or traditional financial services. So now for VASP to fall into that space, there's going to need to be a bit of changes in the way that approach is taken.
Yeah,
and I don't
makes
know if
sense.
there probably wants to add a little bit more color to that as well.
Yeah, anything on that note, Christina?
I'm sorry, I missed the last part of what she said.
Oh, just any follow-on kind of high-level comments on how the VASP or FATF frameworks kind of have rolled out.
Yeah, I mean, there's good guidance out there, but then the questions inevitably always become, how do we implement this into practice? And then beyond that, how are regulators viewing this guidance? You know, it's never a checklist of here's what you need to do to become compliant. You know, there's FinCEN is talking about, you know, more or less codifying the risk-based approach, which is great, but what does that effectively mean? I know they just issued, you know, commentary as well about you know, for the Patriot Act, getting more into, you know, stricter penalties or, you know, being more risk-based. But what would be helpful, and I know I'm not speaking to the regulators here, is just, you know, we need help as compliance officers straining that information down to, practically speaking, what does that mean in our day-to-day? You know, we're doing things like risk rating, and you know, we're trying to do proper risk assessments across all lines of business. But you know, some more, you know, general, you know, strained down day-to-day implementation guidance would be helpful. You know, as guidance comes out, yeah, it's great, but then it's always a mad dash and a scramble. Like, what do we actually need to do now to make sure that our program meets these standards for exams and audits?
And I think in the UK, they had like sandboxes where you could work with regulators through scenarios, especially around the travel rule. I know Nota Bene, RAMP, and some other organizations were part of that sandbox. So the regulators can actually get ideas from the industry, and the industry can actually get ideas from regulators, how to make the process a little bit more streamlined. I think we have to be careful though too. There's been instances, especially around countries that wanted to be the leader in fintechs and leader of having the crypto hubs like Estonia, where they jumped out the gate really, really quickly, and maybe, you know, could be perceived they didn't put a lot of thought about it into it, and they had to kind of like you know, retract and, you know, moonwalk into some of the regulations and to some of the licensing processes they had because their own institutions within their jurisdictions weren't able to meet the licensing requirements.
Yeah, good point. Would love to kind of drill into that kind of jurisdictional specific kind of landscape. And you mentioned Europe and Micah or Mika. I'm still unclear as well of how exactly you pronounce it. But yeah, since we have primarily a Western audience here on the call, would love to kind of dig into what's the story with Micah so far, and then maybe after that can kind of look at the U.S. and where key legislation stands. But would someone kind of take a stab at kind of painting what that picture is since it's been live for 14, 15 months now?
So Mika, I think that Mika is a major step forward, and it's probably one of the most thorough regulatory initiatives I've seen in a while. And it may play a significant role in how other jurisdictions shape their regulatory framework, shape or refine their regulatory framework going forward. It does bring a bit of clarity and structure to the space that I think a lot of people in this space have been asking for a while, but it comes with challenges. It's not, there's still some loopholes and there's still some areas that are unclear, especially for DeFi, because the regulation, it sort of sidesteps DeFi because it assumes that that there's a legal entity or a service provider to license when it doesn't always align with how decentralized protocols are structured. And beyond DeFi, we have the broader challenge of operational. Some have dubbed Mika heavy-handed because they've said that it sort of has a one-size-fits-all compliance requirements, which doesn't always work in this space. So while Mika is a great step, it's a good step. It's a step in the right direction. There's still quite a lot that still needs to be done.
I would add to niche. Sorry, go ahead, Christina.
I was just gonna say I think we'll both probably agree with everything, Nisha said, and then something I'll get into later when we talk more about, practical strategy and takeaways is it's important not to hard code a compliance program around like what today's version of Mika is, because it will change. And to Nisha's point, it doesn't address the different kinds of technology. So, when you're building your program, don't hard code your processes around today's version of Mika or any piece of legislation or guidance. Make sure you design your controls so they can evolve as the rules do, without needing a full rebuild every time a new regulation drops, because inevitably, this will have to kind of bend and flex as we move forward.
And yeah, I was just gonna add to both of your points is I think the good thing about Mika is it's pushing a lot of the travel rule, or they call it TFR rule, forward. So it's going to be forcing companies and crypto exchanges to have these processes where they share certain information. I'm sure like Unit21 can appreciate the scamdemic that we see going on. I think the extra sharing of information, destination information, who's receiving this crypto will actually reduce some of the scams and fraud that's going on, because victims would have to kind of give that information over to the exchange that they're dealing with in order for that transaction to be complete. And it kind of forces a lot of these crypto exchanges that might not think that compliance is something they want to lead with. Well, now it's going to cut into their revenue if they're not following these travel rule regulations, because their transactions just won't be able to be completed. And that's where they make their money. So I think that's the benefit of Mika. I think, unfortunately, to Nisha's point, it's not a one size fits all. And I think some of the smaller crypto exchanges are going to be the ones that are getting priced out of the market, because it's extremely expensive to have now all these blockchain analytics, travel rule tools, compliance programs, robust risk assessments. That's going to price out some of the smaller, I think, institutes that are doing crypto activity in the EU.
Stephen, scamdemic, did you just invent this term, or is this a widely used industry term?
if Unit 21 is not on the call, yes, I invited the term. No, I think that it actually Unit 21 actually has an amazing white paper where they talk about this scamdemic. And the tough part is like regulators have to keep up with technology like AI that scammers are utilizing heavy and how difficult that is. And Unit 21 has a ton of features, but the counterparty risk assessment and the counterparty features is, how they can tell one VASP is sending to another, what information, how risky that other VASP is. And the scamdemic is a huge, probably a lot of the audience has heard about pig butchering, and that is like probably the biggest part. You're talking about the $2 billion industry for transnational criminals.
Excellent, excellent. Well, with that kind of understanding of Europe and the MiCA framework under the belt, let's turn to the US. There's some large kind of regime shifts happening, both at the kind of regulatory level as well as kind of some major legislation in the pipeline. So we'd love to kind of walk through the nitty gritty of kind of the implications of those things.
I think in the US, fragmentation is our biggest challenge. So we've got the SEC, CFTC, FinCEN, OFAC. Everybody's regulating crypto. Everyone's trying to, get their hand in the pot of crypto. Everything's very inconsistent. Crypto is, like it or not, a political issue. There are promising bills, like Fit 21, the Genius Act, but then, their future is still uncertain. Democrats just opposed the Genius Act over the weekend because they're saying it doesn't have stringent enough AML controls and not enough controls over, foreign entities. So what do we do in the interim, since we don't have any control over what's going on at the agencies, when this legislation will pass, how it will pass, and what it will look like? My personal approach is to build to the current highest standard. So to me, based in New York, that's, New York DFS. I work with a lot of crypto companies going for the BIT license, and they're one of the toughest out there in terms of what they expect to see in your application and then in your ongoing AML program and cybersecurity as well. I always advise people use, like I was talking about before, this modular compliance framework. So you have your policy, overarching policy set, but then structure your controls so you can plug in new obligations as they emerge. If the Genius Act passes, you don't want to have to scramble to redo your whole program, especially if you're in the middle of an exam or you have one coming up. You want to be able to operate in an environment that's still certain, take the time to go in and plug in where you need. But overall, your program is structured to withhold all of this uncertainty and fragmentation. We'd love to have some more, cohesiveness and consistency. We'll see what that looks like over the next couple of years. But in the interim, compliance officers are doing the best they can. There's always room to, continue to learn and grow. But that's typically what I, try to recommend to clients and people in the space.
Excellent. Stephen, in a conversation we had earlier, you kind of spoke of, in the absence of kind of major legislation creating clarity, that banks kind of serve as de facto regulators. Would love for you to kind of like, expound upon that thought.
Yeah, it's a statement I heard from Giles Dixon, who's now with Tether. This was back in 2017, and you made that statement, and I'm based in Canada, and it's so true that even if, regulatory requirements say, hey, you only have to meet the standard up to here, the banks are going to say what makes them feel comfortable dealing with the digital asset industry and digital asset or crypto asset service providers. And I think what we have to realize is the bank standards are usually, especially here in Canada, where we're known for our de-risking of crypto exchanges, MSBs, cannabis companies, the banks are going to have a higher regulatory requirement than the actual regulators. And I think companies have to realize that they may check all the box that the regulations require and legislation requires, but you are still going to have to deal with the banks and meet their sufficient requirements, especially in places like Canada. And we saw, in the US, and I don't want to speak to it because I'm sure Christina knows better than I do, but the OCC for a number of years said like, to banks, digital assets are permissible, but they also, in the same sentence, warned banks about dealing with digital asset companies. So it's like, if I ask my wife, can I go out with the boys? And she says, yeah, whatever. Like, technically, I can go out with them, but there's going to be some consequences I know when I go home. And I think that the digital asset industry had that kind of same conundrum in the US. But I'd love to know if I'm accurate in that, Christina. I think OCC is moving a little bit towards being more lenient and guideline focused versus enforcement actions, but I could be wrong.
I think, yeah, we've had we've had compliance by enforcement action for sure for the past couple of years. The SEC was very enforcement and action heavy over the past couple of years. OCC, New York DFS, where I am. That's a great question. I'm not sure. I think in the current political climate, we will start moving away from that a bit more. But then we don't just have, the federal regulators, we also have the state regulators. So if you're a crypto exchange, you're registered in every state as a money transmitter, money service business. And then at the state level, you have your money transmitter license, unless you are riding the rails of a banking partner. And I've seen banking partners be, more strict than regulators in some regards. I've gone through banking due diligence packages where they're asking for stuff where I've emailed like experts in this industry and we're like, what is this? What are they asking for? So even if you're not as concerned per se about, the OCC or the IRS or whatever, you still have to deal with the state. You still have to deal with your banking partners. You still have to deal with maybe your yearly external, audit or review and your internal auditors. The pressure can really get to you here.
Yeah, definitely. Okay, so one last kind of question in the regulatory realm, rapid fire around the room. If you're testifying to a congressional hearing or an international equivalent, what would you move to put in place regulatory wise as kind of like a concrete piece of advice to people who are mapping out these frameworks?
I love that question. Definitely some interoperable audit standards across jurisdictions. It's not fair and it's really not a good use of compliance teams' time to reinvent documentation and control testing just because they're expanding to a new region. Beyond that, a global risk tiered system. Not all crypto activity carries the same risk. A $50 stablecoin transfer I don't think should be regulated the same way as like a complex derivatives trade on a decentralized exchange. Proportionality matters. Tailoring requirements based on risk would allow innovation to continue while still addressing real threats. When we get down to the nitty gritty of it, we're here to try to address the real threats, not get lost in the noise of having a one size fits all program that at the end of the day, let's look at the statistics, is still letting loads of, money laundering and illicit activity flow through the global economic system. I know we're going to get to questions later, but I really love this question. Someone asked the question, what's easier to launder, bank deposits or crypto? That is such a fantastic question because crypto takes all the heat, right? Crypto's easier to trace, it's faster to move, it makes it attractive for low dollar, high volume fraud. But on the large scale, laundering is still happening and easier through traditional banking systems, which rely on slow audits and legacy loopholes. Public blockchains leave a permanent trail. And there's still issues with that. I'm not going to get into that too much right now where wire transfers don't. But crypto is still, the scapegoat. So yeah, I think really thinking about this in terms of where is money laundering and illicit activity taking place in the financial ecosystem, and how can we look at this more holistically? We really need to have those conversations.
And I'd say I'd push for a global baseline for crypto licensing and oversight. Like it would cover things like capital requirements, governance structure, which I think is just really important, client asset segregation, mandatory audits. And I really think that these would really help prevent the kind of collapses we've seen in the past in the crypto industry, which has sort of put a bad shadow over the entire crypto industry. I think most people think that with all of what we've seen in the past, crypto is that. Crypto is failing. It's not a good thing to invest in. But I think for a global baseline, that may help a lot, because the bottom line is, I really think that institutions want clarity and consistency. So why not give them the rails to operate safely without killing the innovation that the space was built on?
I'd add three quick things. One, we should have more crypto regulators. Like in Dubai, they have a virtual asset regulatory authority. It's specifically for virtual assets as a regulator that has the expertise, or at least the most of the expertise in that lens. I think there should be more of those around the world. To Christina's point, trying to bolt on crypto regulation on top of these archaic systems with archaic ways of thinking, I don't think is a great idea. The second thing is, I think we need to focus a lot on counterparty risk, and I know Mika is doing that a lot, where a lot of these bigger crypto exchanges are interacting with exchanges that aren't necessarily sanctioned, but they don't do KYC. They're not that compliant with investigations. We should be really cutting off these exchanges from getting liquidity and having access to some of the largest exchanges around the world. So we should be really, I hope that the travel rule will help with that as well.
This travel rule has been mentioned a couple times. Stephen, maybe, or Nisha, can kick it to one of you two to kind of just like maybe unpack it a little bit more. Like, where is this coming from? Where is it in place right now? And then maybe kind of what the imminent future for it looks like. If not, we can cover it, later on.
I was gonna let Nisha go ahead. I'll give my synopsis, but I'll let Nisha go ahead.
No, you can go, Stephen, and then because I want to add a couple other things.
Awesome. I say travel rules basically you have to send certain information and about who you're sending the funds to. They have it in the traditional aspect. I'm not going to go too deep into it, but basically in order to complete the transaction, you have to have, or the exchange that's sending crypto to another exchange has to get certain information about the destination and verify that exchange. And then also in Mika, they have to identify what's the risk of that exchange. Like, are they a compliant exchange? Do they have a robust AML program? So you can see it's quite onersome in crypto because that's not really the way crypto works. It's supposed to be more decentralized and more peer-to-peer. So I think that's the hardest part of the travel rule. And then the biggest issue is there are solutions like Nota Bene and others, but not all of them speak to each other. So now you have a bunch of different solutions that are supposed to be helping, process transactions, but they are not all interoperable. So there's a huge problem with that. And I think Nisha and Christina also mentioned that there's certain jurisdictions that have, are implementing the travel rule, and then there are others that haven't. So what happens when you're doing transaction from one jurisdiction to the other? You have this whole sunrise issue of, halfway around the world, you're able to conduct a transaction pretty easily. And then there's certain jurisdictions that haven't implemented the travel rule, which makes it almost impossible to conduct a transaction.
Yeah, and I mentioned FATF earlier, and travel rules stems from recommendation 16 of FATF, and it was sort of modified to fit into this space, and it pretty much requires VASP to collect and send like certain information relating to the sender and receiver of transfers, pretty much like what happens in a bank transfer, in a wire transfer, and so it's really just about traceability to ensure who sent what to whom. And globally, we've seen countries like the US, UK, Singapore, and now the EU, they're enforcing it across various thresholds. But I think for it to really work and for it to be good in this space, it has to be enforced and adopted globally. That's the only way I really think that it'll work, because at this time, the challenge now is technical interoperability between VASP and balancing privacy with compliance. And it's tricky in this space. So finding like where there's no central party to collect or send the data, it's a work in progress with travel rule.
Excellent. Yeah, no, that's super helpful. So I want to kind of continue drilling into the very nitty-gritty kind of practical and tangible pieces of advice for compliance and risk professionals. And then, I mean, even if folks on the call are not compliance and risk professionals, I think everyone can learn from these kind of, granular insights. But so the kind of want to start this off by, saying there's an existing suite of components of the traditional or legacy system that risk and compliance folks would be very familiar with, like transaction monitoring, auditing, audit trails, privacy, data integrity, a lot of the stuff that's come up now. How does crypto change these things? And maybe kind of we'll keep it as broad as that, but how do these very compliance native components change with kind of crypto native tech?
So we've seen a lot of iterations of this over the past couple of years. You know, the fact that we have awesome companies like Unit21, TRM Labs, Chainalysis, you know, is kind of testament to the fact that we are trying to take, you know, some of these controls and processes and figure out how, you know, to apply them to crypto. So, you know, in terms of just, you know, the standard of transaction monitoring, we're used to fiat monitoring, but in terms of crypto, we have to have on-chain monitoring, which is, you know, where Chainalysis, TRM Labs, all of them come into play. And they've been doing a good job of it. But I think where we're seeing breakdown is the fact that, again, we have to constantly consider what's happening, you know, with the tech and the use case for it, and figure out what more can we be doing as compliance officers moving forward, to make the programs more auditable, but also, you know, for the why we're here, which is to catch criminals. I think that, you know, something like real-time multi-chain monitoring is no longer a nice to have. You know, it's quickly becoming the expectation. It certainly is in New York. If you're only watching activity on one particular chain or protocol, or you're only flagging, you know, large transactions vis-a-vis like heuristics, like, you know, what we're used to seeing in the large legacy transaction monitoring systems, you're already behind. Fraudsters are chain agnostic, and traditional thresholds, you know, traditional heuristics are going to miss most behavioral red flags. Behavioral risk scoring is really important now. You would be surprised at the number of clients that I have that consider risk rating only at onboarding and not on an ongoing basis. And that has to be baked in to, you know, an effective program. Looking for shifts in wallet activity, transaction patterns, new interactions with higher risk protocols, which are mushrooming up faster than I could ever keep, you know, on top of them. It's really important to be doing stuff like that. And then this was definitely touched on earlier, and this is a cause that's near and dear to my heart. Another webinar that I was on, someone mentioned bringing compliance into the lab. And I can't speak that from the rooftops loud enough. The earlier you bring compliance into building whatever it is you're building, you know, products or systems, and have them work hand in hand with engineering, it will make these processes, these controls, so much easier in the long term. And instead of trying to do all this retrofitting, you can't layer auditability after the fact. It has to be part of a product's architecture from the start.
I want to jump on that. I think Christina is absolutely right. And I think one of the interesting things with transaction monitoring from traditional to crypto is that, you know, if you're, you know, you buy drugs and you go, you know, you get cash, or you sell drugs and you get cash and you go deposit at the ATM, there's very little oversight. The bank might see the deposit, and that's really all they're going to see. You know, it's hard to like follow that transaction. But if I am using crypto to buy drugs on the dark net or sell drugs on the dark net market and then go deposit at Coinbase, let's say, that full transaction history, for the most part, depending on what type of wallets, is completely visible, which leaves, unfortunately, crypto exchanges at a disadvantage than a bank, right? Because the bank doesn't see any of that transactions, whereas regulators can see that transaction using blockchain analytics tools like Chainalysis and TRM Labs. So if Coinbase is not quick to report that activity and send it through to the FIU, or to make sure that information gets into law enforcement hands, the regulators see that in real time. Similar to sanctions, the regulators will see if any of these crypto exchanges have any exposure to sanctions. But if you're an HSBC or a Santander bank and you have somebody that sent a payment to a sanctioned entity at another bank, The regulators have no view of that until they have to do a further audit or get some kind of suspicious activity report sent to them. So I think in crypto, everyone's cards are on the table and everyone can see that, which actually benefits us as well because crypto Twitter, the guys there and girls there are able to track some of this illicit movement when it comes to fake meme tokens or rug pulls. They're able to actually assist the community with tracking down some of these illicit actors without needing to be working with law enforcement, without needing to be paid by an exchange. They're doing it on their own because they have exposure, the same transparency that anyone else does working in this field, which is a great thing, but it also makes it tougher on compliance professionals trying to keep up with these real-time investigations.
And to add to what Christina and Steven said, I think that regulators, they're really looking for what I would call governance in action. They want to see like clear demonstrable evidence that your policies are being enforced and it's being followed, especially as it relates to your decision making, your updates to rules, clear documentations, approvals for high-risk cases, especially PEP sanctions. They want to see that although you have those policies and procedures, that you're actually following them. So we can't, it's no longer just about, they're not just taking your word for it. So you're saying, yes, I'm onboarding clean. You can trust that I'm doing it. They also want you to demonstrate that you're doing it and have explainable systems. And if you can't do that, then regulators are obviously going to assume that your risk is unmanaged.
Just to clarify to everyone, the drug that I bought, Stephen is referring to as caffeine. So just to be on the record about that.
I heard Christina mention mushrooming, so like that was the first thing that came to my mind was a drug analogy.
No, all good. But also to Stephen's points, yeah, Twitter is a really interesting place to watch on-chain sleuths in action. So people like Zach XBT or kind of even more popular folks like CoffeeZilla, I mean, can within hours kind of have a post-mortem of a scam or kind of fraudulent extractive type event. So I highly recommend following folks like that. Want to kind of ask, let's say you're on this call, you're a risk or compliance professional. What's y'all's forecast of what's going to be coming down the pipeline in terms of requirements and kind of very specific rule changes that are going to go into effect over the next, year to year and a half? What do you see come into roost in that realm?
Yeah, I think we've all got some cool different answers for this. So I've seen a couple questions here touching on DeFi a little bit, and it's a fascinating space to talk about. I think in terms of compliance, it's going to bifurcate. I've already started to see it a little bit, in my client base. We'll have some compliance optional, DeFi at the fringes, and compliance integrated DeFi that work with, banks, insurers, regulators. The second group will, I think, dominate the growth curve. So I think someone had asked a question about, if we force crypto, what was the question? I liked this question. If we force crypto to follow all the regulations of traditional wire transfers, what happens to the anonymous nature of DeFi? Does it stop being available? I don't think it stops being available, but it will shift to the margins. And I think that there's a balance here. You can create a layered system where you regulate things, access points like wallets, exchanges, and payment apps that can enforce some measure of KYC and compliance. And it's not a one size fits all. We're not trying to jam legacy compliance into a new tech here, but we do need some measure of compliance. We do need, to know who we're dealing with at the other end. Where's the money coming from and where's the money going? But I think, and I'm definitely getting out of my depth talking about this a little bit because I'm not a tech person, but I think the underlying DeFi protocols can still remain, open and permissionless. So, I've seen some DeFi companies start to adopt more of the, okay, we're not a fully regulated financial institution, but we'd like to work with certain bank partners, we'd like to be seen as compliant. So we've started moving down the path of, okay, we have some basic KYC, we have some training, we're even going to bring you in to audit it, but we want to make sure that you're not going to go full, bank audit on us. So I see, DeFi kind of splitting into those two camps. And I personally do believe the ones that, integrate compliance more fulsomely into, into their company are going to, I think they'll keep innovating. And there won't be as much heat on them in terms of the regulations. So yeah, I will let the others pick up from there.
I think we're going to see crypto compliance move from being reactive to more proactive and in a big way. So we'll see a focus more on real-time monitoring, and dynamic KYC will become the norm, because regulators will, as I mentioned earlier, they'll want to know that you're not just onboarding clean, but that you're actually staying clean. And we'll see a bit of a global alignment, especially with MiCA coming into effect. And one big thing I think is we're going to see a big shift in AI. AI, I really believe, is going to change the game, and not just in how we detect or manage alerts, but in how regulators audit and enforce. So if you're in the space and you're using AI, I think you really need to be ready to explain how it works, where the guardrails are. And at the end of the day, I feel like we're heading towards a world where compliance is embedded and not bolted on. So it's important for us to be able to demonstrate the tools that we're using and why we're using it. But I definitely think that AI is going to be on the forefront in the coming months.
And I think where AI will help the most is consistency. I've been through a couple of these audits, and regulators really like to scrutinize consistency of reporting. Like, hey, you did this investigation. It's pretty similar to this other one. One of them you reported, one of them you didn't report. And with most of crypto being very digital first, or at least digital nomad first, where most people aren't working in an actual office. So there's not that osmosis of working with people and seeing how they handle certain cases. Most of us are remote first. And I think that consistency of training, it really gets, divided out once you start growing your team, working with jurisdictions that might be more affordable to hire people. So I think the AI will help be able to look at all the investigations that, globally that a company's done, and see some trends in, hey, why are we only filing 60% the same on this, fairly similar scenario? So I think, to Nisha's point, that's where AI, I think, will help out with some of these global crypto exchanges, and seeing some unity in the way they approach, and not just reporting, getting into like things like policies and procedures, where not everyone's following suit across different jurisdictions.
Appreciate that. Appreciate those answers. So we have a lot of Q&A to get to, and so appreciate everyone in the audience who's submitted one of those questions. And yeah, welcome any more. Have one more question to get through before we get to those questions. And we asked our excellent panelists ahead of time kind of what some of the actionable takeaways, or like most concrete best practices, you would recommend to risk and compliance professionals. And I compiled those here, and I'll show them on the screen, and then we'll get any follow-ups from them. But just to show these, if everyone can see that, can I get a thumbs up from Steven or Nisha? Okay, great. Yeah, a lot of these have been mentioned, but just to recap: shift from static to dynamic risk monitoring, building modular and adaptable compliance frameworks, viewing the future as not DeFi versus TradFi, but lots of bridges and interoperability between them, having strong programs that aren't just about meeting requirements, but building trust. And then banks, for now, while thorough legislation is yet to be passed, being de facto regulators, so being really kind of keyed into those things. Any other kind of like follow-on best practices?
Yeah, I just wanted to add quickly. I think compliance is not compliance is not a tick box approach. That would never work in this space. So we should never try to copy and paste traditional compliance into this space. We have to start by truly understanding the tech that we're working with, build strong partnerships internally, and that includes cross collaboration with engineering teams, because in this space, we really can't survive without engineering. You have to work with them. And externally, staying plugged in with regulators, with your peers. And finally, I would just say, invest in flexible tooling. Like in TradFi, the rules are mostly static, but in crypto, we need systems that adapt fast. And that's where we use tools like Unit21. That's where they come in, because they allow you to quickly build, to adapt quickly, to tweak transaction monitoring and case management flows without really having to wait on engineers. So you can do all of that with Unit21 easily. And it just gives compliance teams the agility to respond quickly and to move fast.
Christine,
Thanks for
you
that,
want to go
Nisha.
ahead?
Yeah, I mean, a couple of these takeaways just to kind of touch on what they mean. A few of them I had tossed on there. You know, using shifting from static to dynamic risk monitoring. Like I was saying earlier, we have to start looking at, you know, a user holistically. It can't just be broken out into pieces like they're onboarded. Okay, now it's transaction monitoring. Okay, now we're looking at adverse media. Okay, now we're doing follow-up monitoring. Like we have to move away from, you know, this this multi-process control system into looking at the picture holistically. You know, real world risk changes constantly, and your processes should be reflecting that. And that kind of bleeds into the second thing that I talked about, you know, modular adaptable compliance frameworks. We don't have the luxury of waiting for perfect regulatory clarity. We see that in the US all the time. There's legislation out there, there's, you know, people playing politics, and we don't know what's going to happen, when it's going to come, what it's going to look like. So get ahead of the curve, make sure you're designing your controls in kind of like flexible layers, so you can plug in new rules, vendors, jurisdictional requirements, without rebuilding everything. And then one thing I didn't have on there that I definitely wanted to bring up, that I see a lot in practice with the teams that I work with, is make sure that you're documenting your decisions behind why you're doing things, and not just the processes themselves. Like I call it a compliance journal. It can be whatever you want. It can be a Google Doc. You know, it should be auditable, but the goal is to log key decisions, you know, especially for your edge cases, especially for exceptions. Why was this account approved? You know, why was this escalated? Why did this raise a red flag, but they still made it through? How did you handle a gray area? I see this almost every day in my business. You know, when I do audits myself, I go in and say, well, why did you choose to do this? I'm not sure. I'll have to go back and check. I'm going through a DFS exam. You know, I've been through DFS exams with clients, and the DFS is asking them, you know, why did you do this? Like you have these manual processes. Are they documented? Where's your logic and rationale? And it's just someone made a decision on the fly and it wasn't written down. So whatever you want to call it, I call it a compliance journal. That is definitely one of my top takeaways for mitigating risk.
I love what you said there, Christine, about getting ahead of the curve. I think the problem with a lot of crypto exchanges is nobody wants to go first. Nobody wants to build up these robust compliance programs because they're scared they're going to lose market share to the other crypto exchange just next door that isn't implementing these. And I think that's a not a great way to look at it. I think we should be. I think intent has a lot to do with the way the regulators look at your compliance program. So when the travel rule and blockchain analytics and all these things and compliance programs come out, if you're the last one to try and at least achieve, some kind of regulatory requirement, and then you're complaining at all the meetings that this isn't fair or this is not what crypto's for, I think you're going to struggle with a regulatory audit, because the regulators are going to see that you didn't do anything in that time that they were discussing it. We're even seeing now a lot of DeFi protocols are tapping into tools like TRM and Chainalysis and finding at least, putting in the bare minimum, like, hey, let's just make sure that our DeFi, transactions aren't transacting with North Korea or other sanctioned, jurisdictions. So they're putting in at least the minimum that they need to at least show that they have compliance in mind. And, you want to do that. I think, many people will look at the examples in the real world and say, well, this exchange didn't do any compliance and now they have, this huge market share. But I'm kind of bougie. Like I can't sleep on a metal bed and eat bologna sandwiches all day. And I don't think a lot of crypto companies want to have the outlook and the outcome that not thinking about compliance at all until the last minute is going to warrant you. So I think thinking first, like how can we at least start to implement, start to have conversations versus like letting everything pass by and not wanting to be the first one to put anything in compliance and then seeing the ramifications of those in the long run.
Yeah.
Yeah, I think eating bologna sandwiches all day long would be a pretty bad ramification.
Can't have that. Can't have that. Well, really appreciate that discussion. Want to dive into our Q&A here shortly, but before we do, have another brief note from our friends at Unit21, who we want to shout out for making today's conversation possible. Unit21 is a no-code platform that provides tools for detecting and preventing financial fraud and money laundering, things we've discussed today. It enables compliance teams, fraud analysts, and risk operators to create, manage, and adapt rules and workflows without needing an engineering team or resources. So if that applies to you here on the call today, we'll be sending out more information in our post-call email. So Unit21, they can handle transaction monitoring, so real-time and batch monitoring for user behavior and financial transactions to detect any suspicious patterns, as well as case management. So they've got a comprehensive dashboard for investigators to review or triage, resolve alerts, and got audit trail capabilities for compliance as well. Risk and rules engines, no code configuration that allows for rapid creation and adjustment of detection logic without involving engineers. So using a lot of AI on the back end to kind of do the code and engineering lift so you don't have to, as well as data infrastructure. So support of the large amount of data sources within the crypto industry, from event data, identity data, third-party APIs, and this bolsters contextual decision-making all around. So Unit21 customers include fintech and digital banking like Green Dot, crypto exchanges like CoinList and Crypto.com, payments and remittance platforms like Chime and Gusto, online marketplaces like Patreon and Wolt, and as well as large financial institutions like CU and Patriot Bank. So again, thanks to Unit21. Appreciate you bringing this conversation to life today. So with the couple minutes that we have left, would love to dive into the audience Q&A. Let's return to an earlier one that was touched upon. Our good friend, the daily newsletter author here at Blockworks, Byron Gilliam, asked, what's easier to launder, bank deposits or crypto? So maybe rapid fire with a brief explanation, but love to kind of get everyone's take on that.
Yeah, I think I touched on that earlier. I've been trying to keep an eye on Q&A as we've been going through and answer what I could. I lost my place a couple times, but I love that question because, you know, working in crypto, and I'm sorry, this is not rapid fire. My answer is honestly, bank deposits. But working in crypto, with crypto getting the bad rep that it does, majority of money being laundered is still going through traditional finance.
Bank deposits for me as well. Crypto's, way easier to trace, even using some of the more opaque blockchains. I would rather trace crypto all day long.
Yeah, I agree. Definitely.
Pretty consensus there. So that's great. You don't need a subpoena to look at an on-chain wallet. So that's certainly helpful for that. We got a couple questions on stablecoins. So maybe would love anyone's thoughts on how the different models of stablecoins, maybe decentralized issuance versus kind of the more common centralized issuers like Circle or Tether, any implications for the risk and compliance space, specifically with stablecoins, and then maybe how you see the landscape of new entrants into the stablecoin game, like large incumbents, Visa, MasterCard, Stripe. Any thoughts welcome in that realm?
Christina, you look like you're going to say something, so I was going to let you go.
Yes, and then I was like, wait, I'm on mute. Yeah, no, I saw one of those questions about private stablecoins versus CBDCs, and I think that's a really, interesting question. My thought is CBDCs kind of prioritize systemic trust, like policy alignment, and they're more designed for like macro level objectives, like monetary policy, financial inclusion, but they often come at the cost of speed, as we all know, and maybe even user privacy, whereas Private stablecoins are more market driven. They move faster, they integrate into ecosystems, they respond to user needs. And I think that gives them a competitive edge because they're more flexible. They can align with product and financial product innovation specifically and user experience in a way that banks can't. But then on the other edge of the sword, we have compliance. And I think at that point, it really becomes not just a tech race, but a battle over who sets the guardrails. And, are we going to be constrained by like top-down controls? Or is there going to be, as we've all been kind of talking about, more flexibility about building modular, more customizable compliance programs going forward?
Some fun facts about stablecoins: 2/3 of every crypto transactions are stablecoins, which is really interesting. I think Mika's a little bit burdensome, turning stablecoins more into like a digital transaction that you're doing with your bank. I don't know enough about it to like deep down dive in it. And I think to your point, Bennett, with the new entrants in the space, I think there's going to be use cases for each one of those things, like Venmo and Cash App and all these other things. There's going to be specific use cases. I still think Tether and Circle are still going to lead the way in both of those categories. I think Circle's, executives have said it the best, that you don't want the government building airplanes. You want the government regulating the way that airplanes are built. You want the private sector building those airplanes. And I agree, that's a really great statement about what I think about stablecoins versus CBDCs. I think I'd rather leave that into the private sector's hands versus having governments take over.
Makes sense. So also have a couple questions on Bank Secrecy Act and the KYC and AML regimes. So I think I can summarize all of these and maybe another rapid fire question of KYC AML regime, workable or overhaul? What's needed?
I think a lot of things definitely need an overhaul while keeping in mind, the reason behind the rule to begin with. Should we keep the pillars of the BSA? Absolutely. Do we need to start overhauling, what they look like in day-to-day practice to encompass the modern age? Absolutely.
Yeah, I think the short answer for me is that the BSA KYC AML framework, it was never built for DeFi. And we're starting to see a bit of cracks. So the foundation still matters: identity verification, suspicious activity monitoring, record keeping, and those principles are timeless. But the way they're applied, it needs a serious rethink.
Yeah, I thought FinCEN actually did a great job from 2013, considering they were pretty early when it came to at least the AML aspect of crypto transactions. I thought they'd done a great job, enforcing and going after illicit money service providers in crypto that weren't licensed. So I thought they were leading the way. I could be wrong in that. I think some of the other agencies have, taken a heavy-handed approach, but I thought FinCEN has done a great job in implementing guidance in the crypto space.
That's great. Well, unfortunately, we are running out of time. We've got many more questions to get to, but fortunately, don't think we're going to be able to cover all of them here, encroaching on the top of the hour. But I want to first thank our audience and everyone who's been engaged in the discussion and the positive feedback in the chat. Really appreciate everyone tuning in today. I'd also like to thank our excellent panelists, Stephen, Nisha, and Christina, for spending time coming here today and sharing their wealth of insights. I mean, I learned a lot. I hope you all did as well. Would love to kick it around for the final question. Where can our audience continue to follow your work, read more of your work, or get in touch with you if possible?
I think we're all on LinkedIn. Stephen is actually one of my very favorite people to follow on LinkedIn. So if you're not following him, I would hop on that right away. He posts all kinds of cool stuff. So you can definitely find all of us on LinkedIn. My website is my business. It's raycorconsulting.com. I have a blog there, lots more information there. If you had questions today that we didn't get a chance to answer, yeah, please feel free to reach out and ping us, and we'd be happy to answer after the fact.
Yeah, same. I am on LinkedIn as well. I'm not as active, but please feel free to send me any questions that we didn't get a chance to answer today, and I'd be happy to answer.
Same thing. LinkedIn is where I live. You know, if you can't find me on LinkedIn, I probably haven't done my job as a media agency. So, but if my analogies, you know, made you blush and are a little too much for you, you may want to, you may want to follow somebody else.
Well, thanks all. Really enjoyed it. Really fruitful discussion and really pertinent. I know this is a top of mind for a lot of folks, so thought you all were really excellent guides through this discussion and really appreciate you joining. And yeah, hope to catch you on the next one. So thanks everyone for tuning in.
Thank you so much, all.
Thanks for having me. Thanks.
See you.